Most investors don't lose money because they're wrong about the market. They lose money because they put themselves in positions where being wrong becomes fatal. That sounds simple, but it changes everything. The market allows mistakes. What it doesn't forgive is ruin. Charlie Munger understood this better than almost anyone. He didn't believe success came from constant brilliance. He believed it came from avoiding irreversible damage. Most people think investing is about finding the next big winner, the next great stock, the next once-in-a-lifetime opportunity. Munger thought that mindset was dangerous because when you focus only on winning, you ignore how people actually lose. They lose by taking risks they don't fully understand. They lose by using leverage they don't need. They lose by believing that past success means future safety. And most of all, they lose because they never ask one critical question. What could permanently knock me out of the game? Munger didn't start with how to get rich. He started with how people go broke. That's inversion. Instead of asking, what should I do to succeed? He asked, what must I absolutely avoid? Because in real life, you don't need many good decisions to win, but one bad decision can end everything. Markets crash, businesses fail, recessions happen. Those events don't destroy investors by themselves. What destroys investors is exposure, fragility, the inability to survive a bad outcome. Munger saw investing as a long journey, measured not in months, but in decades, and in a journey that long. Staying alive matters more than moving fast. You don't need to be the smartest person in the room. You don't need perfect timing. You don't even need extraordinary insight. But you do need to avoid decisions that have no recovery, because compounding only works. If you're still standing, this episode isn't about how to beat the market. It's about how not to be eliminated by it. It's about the inversion rule, the quiet discipline of avoiding ruin, and why not doing stupid things. Consistently is one of the most powerful strategies ever created. Most people approach investing by asking one question: how do I get rich? Charlie Munger started with a very different one: how do people fail? This simple reversal is what he called inversion. Instead of looking for success, he studied disaster. Instead of copying winners, he examined what consistently destroys people, because success leaves clues, but failure leaves patterns. When you invert the problem, you stop chasing outcomes and start eliminating danger. Munger believed that many problems are easier to solve backward, not by adding more clever ideas, but by removing obvious mistakes. If you want to have a happy marriage, ask what ruins marriages. If you want a long life, ask what shortens it. If you want to build wealth, ask what wipes it out. The answers are rarely complicated: too much debt, too much confidence, too little margin for error. Most investors never ask these questions. They focus on upside, on potential, on stories. Inversion forces you to look at risk first, at fragility, at the things that can't be fixed once they break. And this is where most people get uncomfortable, because inversion is not exciting. It doesn't promise quick wins. It doesn't give you bragging rights. What it gives you is survival. Munger understood that life is not about making perfect choices. It's about avoiding catastrophic ones. You don't need to know every way to succeed. You just need to know a few ways to fail and stay far away from them. Inversion isn't pessimism, it's realism. It's the discipline of asking, what could go wrong, and what would happen if it did? Because once you see the game this way, You stop playing to win fast and start playing to last. Most people believe wealth is built by big wins. They think success comes from finding the perfect investment, the massive opportunity, the once-in-a-lifetime trade. Charlie Munger didn't see it that way. He believed wealth is built by staying alive long enough for compounding to do its work. And compounding only works if you avoid permanent loss. This is where most investors misunderstand the game. You can be wrong many times and still survive, but you only need to be wrong once, in the wrong way, at the wrong scale, to be finished. A single decision with no margin for error can erase decades of progress. The market doesn't reward courage, it rewards endurance. Munger understood that the real enemy of wealth is not low returns, it's ruin. Because once you're ruined, there is no comeback trade, no recovery strategy, no second chance with the same capital. That's why chasing big wins is dangerous. Big wins often require big risks, leverage, concentration, confidence that the downside won't happen. But the downside always exists, even when it's invisible, even when everyone feels safe. Avoiding ruin doesn't feel impressive. It feels boring, slow, almost unnecessary, until it isn't. History is full of smart people who disappeared, not because they were stupid, but because they ignored the possibility of being wrong. Munger knew that investing is not about maximizing returns. It's about minimizing regret. You don't need the best decade. You need enough good decades in a row. And that requires discipline, the discipline to say no, to walk away from situations where one mistake can destroy everything, to accept lower returns in exchange for survival. Because the most powerful force in investing is not intelligence, it's time. And time only works for you if you protect your downside. This is why avoiding ruin beats chasing big wins every time. The goal is not to win fast. The goal is to never lose in a way you can't recover from. Once you understand that, the game changes. Most investors don't get destroyed by bad luck. They get destroyed by choices that quietly amplify risk. The most dangerous ones are rarely dramatic. They don't feel reckless at the time. They feel reasonable. The first silent killer is leverage. Leverage promises speed. It turns small gains into big wins, but it also turns small mistakes into disasters. When things go right, leverage feels like intelligence. When things go wrong, it removes choice. You don't get time to think. You don't get a second opinion. You get forced out. Leverage doesn't wait for you to be right. It demands that you be right immediately. The second killer is ego. Ego convinces people they understand more than they do. That past success guarantees future safety. That warnings apply to others, not to them. Ego hates limits. It hates humility. It hates walking away. But markets don't care how confident you feel. They don't care how smart you sounded last year. They only care about exposure. The third killer is overconfidence. Overconfidence is subtle. It builds slowly, trade by trade, win by win. You start believing the outcome was skill, not luck. You increase position size. You take risks you wouldn't have taken before, and eventually, you meet a situation you don't control. That's when overconfidence collects its fee. These three forces often work together. Leverage magnifies the damage. Ego ignores the warning signs. Overconfidence blinds you to the downside. None of them feel dangerous at first. That's why they work. They don't announce themselves as threats. They show up as opportunity. This is why inversion matters. Instead of asking, how can this make me rich? You ask, how could this destroy me if the answer is, one bad outcome wipes me out? Then the decision is already made. The smartest move is often the one you don't take. Avoiding these silent killers doesn't make headlines, but it keeps you in the game, and staying in the game is the whole point. Most investors underestimate one brutal truth: losses hurt more than gains help. This isn't opinion, it's math. If you lose 10%, you need more than 11% just to break even. Lose 20%, you need 25% to recover. Lose 50%, you need 100%. The deeper the loss, the steeper the climb. Charlie Munger respected this reality deeply, because math doesn't care how confident you are. It doesn't care how long you waited, and it doesn't care how sure you felt. This is why avoiding big losses matters so much. People often focus on upside. They ask how much they can make. They rarely ask how much they can lose. But compounding works both ways. Small losses are manageable. Large losses change behavior. When losses get big, fear takes over. Decision-making collapses, and mistakes multiply. Munger understood that ruin is not just financial, it's psychological. Once confidence is shattered, people stop thinking clearly. They panic, they chase, they do the very things that create permanent damage. This is why the math of ruin is so unforgiving. Every large loss reduces future opportunity. It shrinks your ability to take advantage of the next good idea. It limits your choices. Avoiding ruin is not about being conservative, it's about being realistic. Because the market does not offer equal recovery. It punishes excess. And it rewards survival. You don't need heroic gains. You need consistency. You need to protect your capital, because capital is optionality. It gives you time. It gives you patience. It gives you flexibility once it's gone. So are those advantages? This is why Munger focused more on avoiding stupidity than chasing brilliance, because math guarantees one thing: the bigger the hole, the harder it is to climb out. Inversion only matters if you can use it, otherwise it's just a clever idea. Charlie Munger believed that good decisions often come from simple rules, rules that are easy to remember and hard to violate. The first rule is to avoid what you don't understand. Complexity creates blind spots, and blind spots are where ruin hides. If you can't explain how a business makes money, if you don't understand the risks, if you're relying on someone else's confidence, that's not investing, that's hope. The second rule is to avoid debt you can't survive. Debt reduces flexibility, it removes patience, and it turns uncertainty into pressure. Munger was not against debt. He was against fragility. If a small downturn can force you to sell, the structure is already broken. The third rule is to avoid situations with no margin for error. Some decisions allow mistakes, others don't. Inversion teaches you to identify which is which. If being wrong once ends the game, that decision deserves extreme caution or no action at all. The fourth rule is to avoid permanent decisions made under temporary emotions: fear, excitement, euphoria. These emotions push people to act when they should wait, or commit when they should observe. Munger valued patience because it protects against emotional ruin. Waiting is often the safest move. These rules won't make you popular. They won't impress people at dinner parties, and they won't generate exciting stories. What they do is protect your future self. Inversion is not about doing more, it's about doing less. Less stupidity, less exposure, less overconfidence, and over time. That restraint compounds, not in headlines, but in survival. Charlie Munger never believed that wealth was built by brilliance. He believed it was built by avoiding obvious stupidity. That idea feels almost disappointing because it removes the fantasy that success belongs only to the exceptionally smart. Most people want strategies. They want predictions. They want certainty. Munger wanted something far more practical. Durability. He understood that markets are unpredictable, that cycles repeat, that luck plays a bigger role than most people are comfortable admitting. So instead of trying to be right all the time, he focused on something more important, not being wrong in ways that could not be fixed. He avoided leverage that could force him out. He avoided complexity that hid risk. He avoided decisions where one mistake could end a game. These choices rarely make headlines. They don't create excitement, and they don't impress people in the short term. But they protect the most valuable asset of all, time. Time allows compounding to work. Time allows mistakes to heal. Time allows patience to turn into advantage. Munger believed that most people fail not because they lack intelligence, but because they underestimate how fragile success can be. One reckless decision, one moment of overconfidence, one situation with no margin for error. That's all it takes. This is why inversion matters. Before asking how much you can gain, ask how much you could lose before chasing opportunity. Ask what could permanently damage you before acting. Ask whether you can survive being wrong. Because survival is not a side goal, it is the goal. In a world obsessed with speed, with action, with constant optimization, Munger chose restraint. He understood that doing nothing at the right time is often the most intelligent move. You don't need to be the smartest person in the room. You don't need perfect timing, and you don't need to win every year. You just need to stay in the game. In the long run, wealth is not built by heroic decisions. It's built by avoiding irreversible ones. Don't try to be smart. Just don't be stupid.